Think about the last time you made your student loan payment. You hit submit. AutoPay sends that little confirmation. For a second, you feel like an adult. Like you're doing what you're supposed to do. Then a few days later, you open your loan dashboard. You expect the balance to drop. Even a little. And it's basically the same. Sometimes it's worse. The number goes up. And you just stare at it, trying to understand how money left your bank account, but your debt didn't move, so you scroll. You look for the breakdown. Interest, principal, fees, anything that explains where your payment went, and that's when the loop starts. You tell yourself, okay, next month will look better. But next month looks the same. Minimum due, payment received, balance barely budges. Quietly, the worry creeps in. Am I going to be paying this forever? Let me be clear about something. This isn't you being bad with money. There's a built-in mismatch that can make your loan feel manageable month to month, while it quietly gets more expensive over time. That moment you just recognized, paying every month and watching the balance barely move, isn't random. It's math. And it's the exact math your repayment plan is built around. Here's what most people don't realize. A lower payment is often created by stretching your payoff timeline. More months, more time, and that means more interest. Interest is the cost of borrowing. And with student loans, that cost keeps ticking as long as a balance exists. So if you pick a plan because it feels affordable today, but your real goal is pay the least overall, or be debt-free by a certain date, you can accidentally choose the wrong tool. This is the mismatch. And it gets worse because of how your payment is applied. According to the Consumer Financial Protection Bureau, your payment goes to outstanding interest first, and only what's left touches the principal, the amount you originally borrowed. So when your required payment is low, you can spend months just servicing interest. That's like paying rent on your own debt. Here's the twist. Some situations can even add interest onto your balance through capitalization. When unpaid interest gets added to principal, so you start paying interest on interest. The system optimizes for a payment you can make this month. It does not optimize for the total cost you'll live with over the next decade or two. And once you see the mechanics, you can spot exactly where your money is leaking. So the first thing to understand is why your balance can look stuck, even when you're paying on time. Student loan interest is basically a daily meter running in the background. The loan has a principal, what you borrowed, and the interest is the fee charged on that principal. According to the CFPB, interest often accrues daily, and when you make a payment, the servicer applies it to any outstanding interest first. Only the leftover amount reduces principal. Now picture a common situation. Take someone like Marcus. He owes about $35,000 at around 6% interest. Using the daily interest method shown by Student Loan Planner, a 6% rate means your daily rate is roughly 0.06 divided by 365. On a $35,000 balance, that comes out to about $5.75 a day, roughly $172 in interest over a 30-day month. So if Marcus is on a plan where his required payment is $200, about $172 is just paying the interest meter. That leaves roughly $28 to reduce the actual debt. That's why the balance barely moves. It's not because he's failing. It's because his plan is engineered to be payable, not to be fast. For you, this becomes a psychological trap. Minimum due sounds like progress. But if your payment barely beats monthly interest, you're not really attacking principal, you're keeping the loan alive. And once a loan stays alive, it becomes vulnerable to things like capitalization. The CFPB warns that under certain conditions, unpaid interest can get added to principal, meaning tomorrow's interest meter starts from a bigger number. Now that you can see the interest-first reality, the next question is brutal. What happens when you stretch that timeline on purpose? Once your payment is low enough that principal barely moves, the timeline becomes the silent killer. Think of repayment term like a treadmill. The longer you stay on it, the more minutes you're paying the interest fee. Extending your term doesn't change your interest rate, it just gives the interest more time to pile up. You can see this trade-off in real numbers. Student Loan Planner's calculator examples show how term length changes the lifetime cost dramatically. For a $35,000 balance at 6%, a 10-year payoff is roughly a $388 monthly payment and around $11,500 in interest over the life of the loan. Stretch that to 25 years, and the payment drops to about $226, but total paid jumps to roughly $67,600, with about $32,600 to $35,000 of that being interest. Read that again. Lower monthly payment, but roughly triple the interest. And this is why affordable can be expensive. Here's a gut check you can do without any fancy spreadsheet. Estimate your monthly interest. Take your balance times your interest rate divided by 12. Then compare it to your payment. If your payment doesn't beat that monthly interest number by much, you're not meaningfully reducing principal, you're just extending the relationship. What does that mean for you today? It means a plan that feels safer month to month can quietly delay everything else. Emergency fund growth, retirement contributions, even saving for a move. You're not just paying more interest, you're losing time. But here's the part most people miss. Paying the least overall is not always the correct goal. And if you pick the wrong goal, you'll pick the wrong plan. You can now see how the balance gets stuck, and how time turns that into thousands in extra cost. But the real leak is the decision mismatch, and you can fix it faster than you think, because once you understand the math, the real question becomes, what are you actually trying to buy with your repayment plan? There are different wins. Lowest required monthly payment, fastest debt-free date, lowest total cost, or qualifying for forgiveness. The problem isn't picking one. The problem is letting the servicer's default pick it for you, and then never checking if your life changed. Here's a real-world pressure point that makes the mismatch obvious. The CFPB's 2023-2024 Student Loan Borrower Survey found that among borrowers who have ever enrolled in income-driven repayment, 45% reported having difficulty enrolling or recertifying. And 14% reported missing a recertification deadline. That's not a small edge case. That's a normal, life happened, moment. Now picture two borrowers. Nina has a toddler and medical bills. She needs a low required payment so the lights stay on. For her, the cheaper total cost goal might be temporarily wrong. Cash flow safety is the goal. Jordan has stable income and no crisis spending. But Jordan stayed on the lowest payment because it felt safe. Never reran the numbers. Never increased payment as income rose. That's how you end up paying interest for years simply because you didn't update the strategy. So what does this mean for you today? It means you need a plan that matches your next 12 months, not your past 12 months. If your income changed, your household changed, or you're pursuing forgiveness, the best move can flip. And the system won't tap you on the shoulder when it flips. It will just keep billing you. So what do you actually do with all of this, without turning your life into a spreadsheet? Here's exactly what to do. No guesswork. Just a quick repayment plan match check. Step 1. Pull 3 numbers today. Your current balance, your interest rate, and your last payment breakdown, how much went to interest versus principal. It's usually on the statement, even if the dashboard hides it. Step 2. Estimate your monthly interest. Balance times rate divided by 12. Then compare it to your monthly payment. If your payment barely beats that interest number, that's why the balance feels stuck. Step 3. Pick one primary goal for the next 12 months. Write the letter down. A. Lowest monthly obligation. B. Debt-free by a date. C. Minimize total cost. D. Forgiveness path. If you keep it vague, the system picks for you. Step 4. Run a side-by-side payoff test. Your current setup versus a faster scenario, even required payment plus $50. Look at 2 outputs, payoff date and total interest. Seeing the quiet balloon in dollars changes decisions fast. Step 5. If your goal is lower total cost and you can afford it, set an extra principal rule. A fixed amount, $25 to $100, on top of the required payment. Then confirm with your servicer how to apply it to principal, not future payments. Step 6. If your goal is cash flow safety, keep the lower required payment, but add a drift stopper. Example. Whenever you get a raise, commit a percentage of the increase to your loan. If you want, comment with your balance, rate, and whether your payment is mostly interest, and you'll know exactly which numbers to check next. And if this is the kind of system mechanics stuff you wish someone taught you earlier, subscribing gets you more of it, simple, actionable, and built to keep more of your money.